Okay, hello everyone. I would like to welcome you all to the academic network session on investment decisions. My name is Ayako Yasuda. I'm a professor of finance at the Graduate School of Management, at the University of California at Davis, and one of the co-organizers of the Academic Network Conference. Academic Network for PRI is a consortium of over 13,000 members of leading academics and practitioners. And it's aimed at bridging the world of academic researchers and practitioners in the responsible investing space. And we do that by organizing events like this conference, some public lecture series, and generally disseminating research insights to spur dialogues between practitioners and academics. This year, we received over 200 papers to the call for papers for this conference, and we selected 12 excellent papers on 5 themes sessions, such as natural capital and also green commitments we just saw this morning. I am thrilled that in this session, the 5th and the final one, that we are presenting the 2 winning papers for the best paper and the best PhD paper award. So here we have on stage Alexander Dyck, Atreya, Tom Gosling, and Conor Kehoe. Each paper in this session makes a significant contribution to our knowledge of investment decisions by delving into how investor beliefs or investor attention affect the investment decisions that they make. So we will begin the session by asking the authors to present their papers, Tom first, and then Atreya, followed by the academic discussant, Alexander, and practitioner discussant, Conor. And the Conor will also present the awards. So without further ado, we'll begin by passing over to Tom.
Yeah, thank you so much. Hello, everybody, and thank you to PRI for putting this together and inviting us. Thank you to T. Rowe Price for sponsoring the prize, which I'm delighted on behalf of myself and co-authors Alex Edmonds and Dyck to accept. It's been a real privilege and very exciting. I'm going to present a survey paper, Sustainable Investing Evidence for the Field, which looks at how portfolio managers incorporate environmental and social, so that's ES, I'm going to use the phrase ES, performance into investment decision making. Importantly, we're focusing on ES performance, not ES risks, because we're interested in how portfolio managers think about the aspects of ES performance that are within a firm's control. So we're less interested in whether they're concerned about the physical risk that a real estate portfolio faces, as opposed to, for example, the carbon emissions of that portfolio. Okay, so the survey basics. So we surveyed, we had responses from 500 equity portfolio managers. Importantly, we're focusing on portfolio managers rather than ESG professionals. Those portfolio managers kind of fall into 2 buckets. So one, the majority we've called traditional investors. So these are managing unconstrained mandates, and the others are managing sustainable funds, which are marketed in some way as being sustainable, ESG, SRI, etc. There's a geographic split. A little under half are marketed in the US. Most of the others are marketed in the EU and the UK. We really wanted to understand how the people making investment decisions are treating these factors. So we haven't got analysts, ESG professionals, or senior executives. It's only portfolio managers. And this is focused on asset managers rather than asset owners. Why a survey? I mean, obviously, archival research is kind of really useful and important. But whilst you might be able to observe, for example, whether sustainable funds do or don't own more sustainable companies, we don't necessarily know why they do it. So is it because of mandate constraints? Is it because they believe that will lead to higher performance? Is it because they're desirous of having impact on those companies and their performance? Whereas a survey enables us to look at the underlying motivations and can help pose questions for future academic research. There's a lot in the paper, so I'm going to just try, probably too much. We're going to have to, pare it down, I think, for submission to a journal. But I'm going to draw out kind of 4 main themes and findings. So the first one is, and I'm going to focus on kind of the contrast between sustainable and traditional portfolio managers. So the first finding is that overall, there's a lot of heterogeneity within each of the sustainable and traditional populations. But in aggregate, they're actually quite similar, right? There aren't as many stark differences between the managers of these 2 different types of funds that you may think. And overall, we find that ES performance matters, but not to the extent or maybe in the manner that we might think. So let me just drill into that a little bit. So the first question we asked participants to rank a number of important factors by their importance for the long-term value of companies that they invest in. And we included strategy and competitive position, operational performance. We separated out governance, okay, because we know that, governance has a relationship with value. We wanted to look at ES performance separately from governance. Corporate culture and then capital structure we included because in theory that shouldn't be all that important. And although respondents in the free text comments, did say, of course, it's difficult to separate these things out, everything's intertwined, and we accept that and acknowledge that, very consistently ES performance was ranked below all of these other factors in its importance of value, including for sustainable portfolio managers. Having said that, in absolute terms, although relatively ES performance was not the most material factor, in absolute terms, it is still somewhat material. So 85% of investors, including 78% of traditional investors, cite at least one ES factor as being material. Now, perhaps unsurprisingly, these scores are on a scale of 0 to 4, so 2, 2.5 is sort of somewhat material. It's not like massively material, but it's somewhat material. Perhaps unsurprisingly, the most material items, ES factors, are those that internalize into value most directly, so employee and consumer factors. At the bottom are some of those that receive a lot of attention, but maybe aren't deemed by the portfolio manager to be so important to value, such as demographic diversity. So ES factors kind of do matter in absolute terms, but aren't the most important relative to other factors, which is, again, perhaps a reality check when we think about the expectations that we sometimes have of portfolio managers to take ES factors into account. What about beliefs? We asked some other questions about beliefs in terms of performance. And here it's kind of interesting that a majority of investors overall, and even nearly half of traditional investors, do believe that good ES performance will typically deliver outperformance in terms of total shareholder return in the future. So, this is kind of quite interesting. There's not a clean split between traditional and sustainable investors. So a significant proportion of traditional investors believe in ES performance as a signifier of alpha, but equally, over a quarter of sustainable investors do not believe in it as a signifier of alpha. So why is it that these investors think that strong ES performers outperform? Well, interestingly, it's not. The most popular response is not that it's ES performance per se that is driving the outperformance, but that strong ES performance is correlated with other factors that signify strong performance. So, the idea here is that it's viewed as an indicator of a well-managed and a well-run company rather than necessarily a value driver in its own right, which again might give some insights as to how portfolio managers are going to think about ES performance, because if they view it more as correlation than causation, that's going to make them less likely to try to drive improved ES performance as a driver of improved value, but more to look at it potentially as a signal. What about the flip side? So interestingly, the answers between sustainable and traditional investors are much more symmetrical on the downside. So here, nearly 2/3 of investors overall, and broadly comparable percentages for traditional and sustainable investors, believe that bad ES performers will underperform. And quite consistently through the survey, in free text comments and in other responses, this idea of bad ES performance creating downside risks came through pretty consistently. So finding number 2 is that both sustainable and traditional PMs prioritize shareholder value maximization. And so other than where defined by very explicit mandates, ES performance is not an objective in and of itself. So here we ask the question, how much risk-adjusted total shareholder return would you tolerate a company sacrificing to improve its ES performance? And sorry, how do I go back here? Red button. And the most popular response overall, actually, interestingly, was that no sacrifice is necessary because there is no trade-off. I'll come back to that. But if we look at the bottom responses, only around a quarter of investors and even only 31% of sustainable investors are prepared to sacrifice even 1 basis point of long-term return in exchange for improved ES performance. And when you get above 10 basis points, which frankly isn't all that much, you're really into very small percentages that are prepared to sacrifice. So on the whole, investors are not prepared to trade off ES performance for financial return. I mean, there is this interestingly kind of large number who do say that no sacrifice is necessary. And this is very interesting. And we followed this up in interviews. And a lot of investors, particularly sustainable investors, do find it quite difficult to accept the reality of a trade-off. You have to push them to quite extreme scenarios before they believe there is indeed a trade-off. And this factor of kind of, this sort of gut feel commitment to, to the value of sustainability is quite interesting to observe. Similarly, when we ask some questions about voting, which I won't go into in detail, but fewer than a quarter of investors have ever voted for a proposal that is even slightly negative for shareholder value. So portfolio managers are generally in the game of maximizing returns subject to whatever constraints are placed upon them. So we have this model of sustainable investors in the academic literature where you have an asset owner, for example, who might have a joint utility function of financial and sustainable returns, but they find it here the reality is the overriding function is financial value. And investors made the point that we're fiduciaries, we can't sacrifice value. Fiduciary duty came through extremely commonly. Finding number 3 is that both sustainable and traditional portfolio managers face constraints, but they're more likely to have negative return consequences for sustainable investors. And indeed, constraints are the main determinant of ES actions that aren't in the service of shareholder value maximization. So let's just look at some of these constraints. The most common consequences, so first of all, there were relatively few investors who had never faced constraints, that caused them to do actions that they otherwise would not have done. And indeed, for sustainable investors, over 80% had faced constraints in some way, shape or form. Mostly these constraints lead them to avoid stocks in some way, shape or form because we've got exclusions, right? That's the most common constraint that these sustainable investors face. But interestingly, the constraints also sometimes cause them to focus on factors in the mandate that maybe they don't think are that important for shareholder value, or in some cases, interestingly, actually could undermine sustainable outcomes. So 30% of sustainable investors said that they actually had to avoid owning ES leaders in a laggard industry or avoid owning companies whose ES performance they could have improved. So sometimes these kind of blunt instruments of mandates, although these constraints actually cause investors to take actions that might have a trade-off with returns, don't actually always lead to more sustainable outcomes. And if we look at the constraints that apply, for sustainable investors, overwhelmingly, it's fund mandates and firm-wide policies that apply. And actually, in many cases, in 39% of cases, this caused a negative impact on returns, these constraints. And the impossible to quantify bucket, when we asked people what they meant by that, they felt that it was probably negative in expectation, but they couldn't really put their finger on it. So, hard constraints are, as you'd expect, much more likely for sustainable funds than for traditional funds, and they're more likely to have negative financial consequences. So the final finding is that ES factors influence stock selection and engagement for both traditional and sustainable portfolio managers, and financial motivations are pretty common. So both mandates and a portfolio manager's belief about the financial impact of ES, these both affect what the holder of a fund gets in terms of ES action. So we've seen that mandates can provide very explicit constraints that cause a trade-off between ES factors and financial returns. But the investor's belief also matters. So if we look here, we ask whether investors under or overweight good or poor performers, ES performers, for any of the following reasons. Now, for sustainable investors, constraints to be consistent with the fund's mandate or firm's policies are the most common reasons for under or overweighting stocks based on their ES performance. But overall, this financial bucket, to avoid downside risk, to improve returns, or to avoid stocks that are volatile, these are also very important motivations. Now, this is what we might generally call ES integration. So it's the financial integration of ES factors into decision making. And what's interesting is that this is very common even amongst portfolio managers of non-sustainable funds. So over half of them incorporate ES performance for financial reasons for at least one of these three factors of downside risk or returns or volatility. So despite the ESG backlash, portfolio managers are just using financially relevant information. Also, traditional and sustainable managers also very commonly engage with companies to improve ES performance. Around 2/3 of traditional managers do, although the reasons for doing so are not so much for impact, but are for traditional reasons of financial performance. Okay, so some key takeaways from this research. So the objective of investors, including sustainable investors, is financial performance subject to constraints. They are generally not seeking to improve ES performance in and of itself. ES constraints are absolutely critical, particularly if ES factors are to be prioritized over financial returns. Okay, portfolio managers aren't going to do this by themselves. They are financially maximizing subject to constraints. Beliefs are heterogeneous and motivated by and motivate ES-related actions by investors. So whether or not a portfolio manager actually believes in ES as a driver of value really determines the kinds of ES action that they take. It determines whether they engage on ES. It determines whether they over or underweight stocks for ES performance. And this question of beliefs and constraints doesn't split neatly along sustainable and traditional lines. So asset owners who are looking for ES performance from their fund managers need to really look under the hood of both what is the detail of the mandate and what the beliefs of the fund manager are. And the differences overall between sustainable and traditional investors are much less than commonly thought. Just very briefly to finish, in terms of future research areas, I think that models of sustainable investing under delegated portfolio management are worth building. We have models that look at investors that have a kind of a joint utility function with financial and non-financial objectives. But actually what's really happening a lot of the time is that such an investor is delegating a portfolio management to an investor who actually has an objective of maximizing financial returns subject to constraints. So I think we need to look at that relationship. But also we need to look at sustainable investing models that don't just have heterogeneous beliefs, don't just have heterogeneous preferences, but also have heterogeneous beliefs about the role of ES in generating value. Thank you very much.
Thank you very much, Tom. And we expect to be a very active discussion afterwards from the audience, so we'll have time for Q&A after the discussants discuss the papers. So the next presenter is the author, Atreya.
Hi, everyone. Thanks for being here. I also wanted to thank the academic committee here for selecting my paper for the Best PhD Award, and it's wonderful to be here and talk about it as well. So this paper is talking about, titled Inattention to the Coming Storm, Rising Seas and Sovereign Credit Risk. The main point of this paper, when I began this quite a while ago, is to understand something that's quite difficult to price, coastal flooding and sea level rise. These types of disasters are very damaging to local economies that are low-lying regions, places like Vietnam, Thailand, that have a lot of population living in these areas. However, when the research began, when I began this research, there was very little research into understanding how these types of physical risks are priced. And that's a lot of my PhD research, is looking at how physical risks are priced across asset markets. Now, sea level rise has been consistently increasing since the 1800s, since when record began. And especially in the last 2 decades, it's been increasing quite substantially. Now, climate science has found that even a little bit of sea level rise will exponentially increase the frequency and severity of these types of coastal flooding disasters when they do occur, right? However, what we find is that sea level change is quite heterogeneous across the world. Some areas will experience much faster growth rates of sea level rise than other areas. So putting these all together, it's difficult to understand how to measure exposure, how to think about it. And so that's what I'll first begin with is this is actually from the Tuvalu Prime Minister, one of the Tuvalu ministers during the COP27, talking about sea level rise and coastal flooding and how it's actually affecting his own small island and developing nation. So these types of physical risks are becoming more talked about and discussed, especially during international summits. So to really put terminology into what coastal flooding is and sea level rise is, I think about exposure. Most of the climate change science has looked at vulnerability to physical risks measured by population exposure, especially since the 2000s and the 2010s. Now, the first term I want to coin is the extreme sea level rise hazard. This is the current vulnerability of a country's population to 1 in 100-year flooding events. This is highly cross-sectional, and these types of events, therefore, have a 1% chance of occurring in any 1 year, right? Next is to look at the changes in this hazard. How is population growth in these coastal areas affecting this exposure? How is land subsidence that's sinking due to sea level rise and potentially coastal flooding disasters affecting this? And then, of course, sea level rise, which will exponentially increase this frequency and severity. This is much more time series risk, and this is consistently changing and quite heterogeneous across the globe. So now that I've coined these terms, this is the main research question of the paper. Quite simply, is the sovereign credit market incorporating exposure to extreme sea level, this is coastal flooding risk, and changes in this extreme sea level rise hazard? This is important for 2 reasons. Credit impairment will restrict a government's ability to issue debt, as well as address future disasters, and of course build infrastructure to protect against sea level rise or coastal flooding events. And then, of course, Mark Carney has said that unaccounted factors will, of course, lead to financial instability and for market participants when these types of risks actually materialize. So, in a nutshell, what this paper does is to try to understand how exposure is being priced into risk, specifically sovereign credit default swap and their spreads. So the difficulty is that sea level rise and these types of coastal flooding disasters are very little time series variation, right? So in the literature, there's been quite a few academics that have been using news and time series variation that's as a result from this news to price these types of risks. So what I do is I focus in on climate summits where I use this as a proxy for investor learning and salience of these types of coastal flooding risks. So therefore, this will be priced into sovereign CDS spreads and sovereign risk in general. So news has been known to co-vary with risk, and sovereign CDSs are useful in this case because they measure the credit health of an economy and, of course, the market uptake of insurance against default. So once I have this news indicator, I'll condition this regression, this relationship, on the exposure of these countries based on ESL, again, coastal flooding hazard, based on the available information on coastal flooding risk at the time. Then, once I understand this risk and estimate these coefficients, from this initial sample of extreme sea level rise hazards of these countries, I'll then further split countries based on how they're vulnerable to sea level rise and this change in sea level rise, right? And what I'll do is to use historical trends in population growth versus what was forecasted by climate scientists during the 2000s and 2010s. And what I'll show you is that these are actually very different. These are 2 very different sets of information that's available for the market. Okay, The main mechanism here, therefore, is this climate information mechanism. So climate risks are more salient during these types of climate science summits because these IPCC reports are much more often discussed during these events. Risks are discussed. Media talks about coastal flooding and sea level rise. And credit spreads have been known to shift around these periods. So therefore, I use a global news intensity index about international summits developed by Ficini et al. They use 13 million news articles published by Reuters and use natural language processing to extract topics, and specifically one of the topics is about climate summits. So again, this is proxying for the level of information and attention that investors in the market pays towards this type of information, right? Okay, this is the overview of the news index. It adds quite a lot of variation that I can use for the analysis. So this is very useful, and I pointed out some areas where this peaked during, especially the Copenhagen conference, Doha, etc. So to look at credit risk, I choose sovereign CDSs, credit default swaps, because I can use multiple tenors, 1, 5, and 10 years, to understand how markets are incorporating this as a short or medium-term risk. They, again, serve as insurance contracts, don't have too many covenants that contaminate the relationship, and then also more rapidly reflect credit information comparatively to the bond itself. They're also quite standardized, and therefore it's useful to understand how this risk is embedded, potentially, in the term structure. This is the main regressions that I'll run. On the left-hand side, I'll use the returns of these CDSs, the spreads, on the left-hand side, and then an interaction term between exposure, this is an indicator variable, 0, 1, and attention, this is the news index. The exposure variable is equal to 1 for countries that are highly vulnerable, and 0 for those countries that are less vulnerable. And the main hypothesis here is that the beta 1 should be greater than 0 for tenors that are 5 or 10 years. This is because, again, these are coastal flooding disasters, and they have a low likelihood of occurring in any single year, but when you add them up, it increases that risk. So I want to understand how this extreme sea level rise is incorporated and what the information that's been available. So I use the preeminent climate science that was available at the time in 2000, 2015, 2010, that was by Vafadis and Newman, that calculated the average percentage of the population that's been vulnerable to coastal flooding risks, right? This was the most sophisticated data that the IPCC would have access to and investors would have availability for. So this is just a small sample of the data set of 59 countries. What I'll do is, since I don't have perfect understanding of what investors are actually incorporating, I'll use a sorting methodology to sort countries based on their vulnerability. So you can see countries such as Vietnam, Belgium, Egypt, a large percentage of their population has been known historically to be vulnerable to coastal flooding. Others, such as Chile, Colombia, have a much less vulnerability to climate change, or sorry, to coastal flooding specifically. So this sorting is a way for me to proxy what the availability of information is. Now that I have this regression, I calculate exposure, I can calculate the estimates across the term structure, right? So for the 1-year CDS spread, I find that there's no difference between the most vulnerable and the least vulnerable countries, but then this increases across the 5 and 10-year CDSs. So at the 10-year level, I find that a 1 standard deviation increase in attention and information processing leads to about a 73 basis point rise in CDS spreads. In comparison, this is somewhat important, such as, for example, a standard deviation increase in the sample for the unemployment rate leads to about a 170 basis point increase. So while it's not as important as these traditional economic indicators, it's still relatively important. Now, I conduct many robustness checks to really confirm the face validity of measuring vulnerability using population exposure and this synchronous mechanism between learning and attention, and then this risk pricing. And there's robust including other variables such as transition risk, other climate shocks, droughts, temperature, etc. And then I also conduct an event study on the Paris Agreement and many others. But what I want to go into next is that now that I show that the market is incorporating this type of risk, I look at the trends in exposure. Again, this is the changes in coastal flooding risk. And on the left-hand side, I'll show you the population estimates and the trends in coastal flooding and sea level rise that was developed by climate scientists. So we'll see that Latvia, Thailand, Egypt, and China were expected to drastically grow in their populations in these coastal regions in comparison to Uruguay, Norway, other countries that were actually having growth inland. In reality, what's actually occurred since 2000, 2010 is what's on the right-hand side. So countries like China and Thailand have grown towards the coastal regions, while Vietnam, for example, has actually grown much more towards inland. So there's two very different sets of information, and the projections that were made, that have been updated now, back in the 2000s, were incorrect, right? So when I perform the same regressions using a different split based on this sample, I find there's no significant difference in spreads, which suggests that the market isn't differentiating between these two types of information, at least synchronicity with news. So what are the potential market frictions that could be causing the market to ignore these forecasted data, this forecasted information, right? Perhaps in an underreaction that could be attributable to inattention towards these risks, right? Harrison Hong and his co-authors find that markets underreact to long-term trends in droughts, and De La Vigne and Paulet find that markets also underreact to long-term trends in population growth, for example. However, these require return predictability. So that means previous values of news will predict positive values of the returns in CDSs. So I do both in-sample tests and out-of-sample tests to show that the market is slow to incorporate this information as they shift towards pricing forecasted information that's made available to them by climate scientists. So what this is saying is that the climate scientists are actually, the market is incorporating this information from climate scientists. However, the projections that were made were actually quite incorrect. So perhaps they're mispricing this information that was available to them. They're mispricing the actual information itself, not the risk of coastal flooding and sea level rise, right? I don't want to make that quite clear. So in conclusion, really, the main research question is the following, right? Is the sovereign credit market incorporating exposure to ESL and changes in this hazard? So one standard deviation increase in attention has led to about a 73 basis point rise for this 10-year sovereign CDS spread for the most vulnerable countries. And the results suggest that there's an upward sloping term structure, so the market is thinking about this as a medium to perhaps long-term risk. And third, the market also has a delayed response in incorporating climate trends. And I put a behavioral mechanism towards this. There's inattention to this more complex information. And then finally, I'll look at population and climate forecasts have actually been incorrect, potentially leading to mispricing about the actual information. But one of the interesting things that I just want to talk about is that now that I have this 73 basis point relationship between coastal flooding, I'm able to actually back out the discount rate that the market is putting on sea level rise and coastal flooding. And I'm finding about a 1% and 5% discount rate for this type of risk. So this is really useful to think about how governments can build infrastructure to protect against coastal flooding and sea level rise, right? So this fairly low discount rate means that we can put a high value on the future damages that will occur. So that means it'll be fairly necessary and a little bit cheaper to build infrastructure to protect against these types of risks in the future, right? So that's a little bit of a policy recommendation that I can bring from the paper. But that's the paper, and there's quite a lot more in the actual paper itself. So I recommend reading it, and I look forward to your questions. Thank you so much.
Thank you. Okay, now that we've heard the two papers, our academic discussant, Alexander Dyck, would discuss both papers.
Okay. There we are. All right. Thank you for including me on the program here. I want to start off, these are award-winning papers. They're great papers. Could they be better? of course, all papers could be a bit better. And I'm going to have a couple of suggestions in that direction as we go along here. But I want to start off why I think they're great papers and hopefully position them into our broader understanding of what's going on with sustainability and investors. So there are two questions that these papers tackle. They aren't the same questions, but they're both important ones. One is like, what are the risks associated with climate change, and are they being appropriately priced? Big question, important question. If they aren't being appropriately priced, then the question is, what can be done about that? And one automatically thinks of maybe investors can be part of that solution. And so the second question, which is the one that Tom's paper really addresses, is really, are institutional investors part of the answer? That is, can they help move if things are being mispriced? Can they move them in the right direction? Can they seek some make some gains as part of that here? And maybe they could even do a bit more to improve E&S performance above that, which, helping the planet in addition to helping their investors. So these two questions, I think, are kind of fundamental to why many of you are here and you're interested in what's going on. And both these papers speak to those big questions. So I'm going to talk about these two papers separately, just going to highlight what I think is most important. Again, this paper is about an important question, are what are the risks associated with climate change? And we can think about transition risks, physical risks here. Obviously, there's like a macro dimension to those kind of risks, not only just at individual firms, but it's going to affect countries, some countries more than others. What I have on the right side here is something from a Dutch regulator sort of flagging the importance of the macro element of those risks. What are the most important physical risks we should focus on? I think looking at the paper today and seeing what's going on, the idea about coastal flooding being an important issue is kind of hot top of mind, and this paper focuses on that question here. Are there overreactions, underreactions? Where is the market? It turns out there's a lot of literature in this area here. There's other papers like this to say that climate risks are being priced, and so that's one of the messages. There are papers that saying, maybe investors aren't quite up to the task and they have to work harder on this. And there also are some papers that say maybe there are overreactions where people focus on their own personal experience and don't actually look at the data. So things are a little bit mixed evidence on the importance of these physical risks and how they're showing up in financial markets. So it's important to kind of dive into that in a more detail. That's what this paper does. So what do they do? What are their main contributions here? Develop new metrics for exposures to physical risks. There's a lot of great climate science with finance in this paper. And there are really two measures of exposure. Are you exposed to sea level rise? This is this first measure he was taking a look at. And are you exposed to changes in the sea level rise? Those are the two measures. I'm going to call them exposed A and exposed B. I think those are both really interesting new metrics. They also examine whether exposed countries' CDSs are affected when there's a tension, and to do this, they're looking at climate summits. I think this is interesting. I'm not quite convinced about this metric, but I get that. And finds that when climate summits, there's lots of attention to what's going on, measured by the number of news stories here. First off, that the exposed countries' CDSs rise. So like, all of a sudden people see the risk. And then the second thing that they find is that there seems to be inattention. At the same time, you're learning information about these other risks. More population is going to be exposed. The market doesn't seem to react to that information. So they react to contemporaneous information, but not to these projections. And so there's the kind of message that comes about this at the end of the day is there's inattention. And the reason why inattention is important for all of you is, hey, maybe there's investment opportunities. Maybe investors can be part of the solution. That's what kind of the message of the paper is. Okay. What my sort of comments on this paper are is it sounds right, that there's probably inattention to these climate risks here. Am I convinced that this paper shows me there's significant inattention to climate risks? I would say not yet. A couple reasons why I'm not convinced, and I would like to see a bit more. They use this index of the number of climate summits. Now, is that really telling me about the risk of sea level rise? It's telling me a lot of stuff. I'm not sure it's telling me that. It's correlated with that, and he's got some evidence consistent with this, but it's, I want some fundamental information. Maybe there's a climate study that shows me fundamental news well, then I should see that. I would like to have more direct evidence that this channel of information driving it into CDSs, I think is a very indirect measure to try to capture that. And I would like you to sort of convince me. You got a study in there about the Paris climate thing here. Problem with that one is you don't really show your index of attention about the news reports around that here. You don't do a diff and diff. I just am not convinced. Like, that's the kind of thing I would like to convince me of the mechanism. Borrowing someone else's index and saying this is what you say it is not convincing to me. I mean, I think it's important. A second one is I got a picture of Thomas Malthus on the right. And if you know much about Thomas Malthus, he was an old economist, a British economist. He has great ideas and he was spectacularly wrong because it's very hard to predict the future. And part of the reason it's hard to predict the future is because we all as humans react to changes, and it's hard, any kind of forecast, to accurately capture what those prices are going to change and how we're going to react. And so his main result is that the investors seem to be not reacting to this forecast changes. And my concern is, well, that's just bad data. Like, the forecasts were completely wrong. These two different measures of forecasts, they're like almost diametrically opposite. So why should the investors be reacting to incredibly noisy information? And maybe it's not inattention to risk, it's just we don't have any really good models, particularly of these complex behaviors at a macro level. That's my concern. The third concern with this paper is that in the end, he's got this great science where he got more exposed by sea level and you use lots of micro data, but you boil it down to two groups, exposed and unexposed. And in the first set of tests, they use one measure of exposed. In the second tests, they use another set of exposed. And all the time, they exclude some countries like Netherlands saying, well, it's not exposed. My last name, you may notice, Dyck, is Dutch. People in the Netherlands are worried about being underwater all the time. Sure, they've spent a lot of money to do abatement, but everyone knows abatement's not perfect. If you've ever been in New Orleans, you thought it was there and it's not there. So there's that concern. All right, so that's about that paper. Second paper, and I'm going to run out of time on this one, is great paper, big questions in the sustainability literature. And really, it's a question about institutional investors, part of the solution. And there's two ways you can think of the solution, is that firms are underperforming relative to the value maximizing level of E&S performance, or firms are underperforming relative to the social value maximizing. And this paper provides insights to address those two questions. Just to give you a bit of context, there's a bunch of theory papers out there that say that if you've got a preference, investors have preferences for better sustainability, that should make a difference. Some papers aren't so sure it should make a difference, but there's surveys that say, yeah, investors seem to care about this stuff. They think they're way below. And the question is, are they going to move it up to the financial value maximizing, or are they going to move it a bit more? I have a paper in this space that shows institutional investors are pretty important in moving the dial in the direction of having improved performance. That's the question this does. There's limitations in this literature. Let me just position what they're doing. Like me and these other surveys have always talked about, let's talk about owners and let's talk about firms. But in reality, delegated portfolio management, we all don't necessarily invest ourselves. We hire someone else to invest. And so there's these portfolio managers in the middle. And this is like, and on one hand, it's like a very simple insight. It's very powerful. Of course, they're portfolio managers. They may accelerate investors' preferences. They may attenuate them. The question is, what do they do? And that's what this paper really dives in to take a look at. I think it's a great paper. I love it when you actually ask portfolio managers and you learn something from that here. The paper's been described already here. Just to remember, why is this important? If portfolio managers believe that ES performance has a very small value impact, then institutional investors aren't going to matter very much, particularly if these guys have control. If portfolio managers believe that what the actual performance that's there right now is pretty much the financial value maximizing performance, they're not going to do much. If portfolio managers believe fiduciary duty says that all you can do is focus on financial value, well, don't expect much from institutional investors. They'll move it a little bit, but they can't move it that much. That's the kind of story here. And what this paper does is it provides insight into exactly those kind of concerns. You know, we find that portfolio managers basically don't think it's that important, E&S performance for value. Just not the biggest deal. Lots of other more important things than E&S performance. They believe you're basically at value maximizing. So they aren't going to think that we need to move this dial that much here, and they believe the fiduciary duty is fundamentally important. That's great new insights that we didn't have before. We didn't do this. And for those that just look at owners and think it's automatically going to show up in firms, it's a very cautionary tale. So you should be a little bit more cautious. I think it's great. They also find not as big differences between traditional and sustainable investors as I thought there would be. I find that's kind of an interesting insight. I thought there were massive differences, and they're just not. Other insights that there's large heterogeneity in beliefs. Well, you just have to read the newspaper and you go from a red state to a blue state, and you know that. So that's nice, but I didn't know, no big surprise on that one. So I get a little check here. And that portfolio managers generally fail to reflect ultimate owners' preferences. Well, it's a principal agent problem. It's almost impossible to get someone to have the same objectives as you. Again, not surprised. Maybe an insight for modeling purposes, but I don't think for all of you it's going to be that big a deal. My suggestions, and I'm going to speak even more quickly on this one here. One is, this is great. I think it's going to be cited. I think this provides, the real message is, don't expect too much of institutional investors. They can't move the dial that much. You're going to rely on portfolio managers. They're going to kind of slow down. That's good. Important insight. In terms of my suggestions, first off, they're weird results. Like, lots of papers have come up with this conclusion that European managers are just fundamentally different than US managers, including the work that Pedro is in the other room. Doesn't show up here. It makes me suspicious about the data. And just like, help me to understand that. It is what you found, but it's just weird because it's not consistent with previous stuff. It's like an outlier in a poll, and you're like, how is that true? So that's just a question I have. Second one is, this is what's going on today. It doesn't mean that in the past, institutional investors weren't fundamentally important to get firms to incorporate ES issues. It just means today they think they're at the financially value maximizing. I think I had this paper in this, the JFE that said that what we found, institutional investors were important in moving them to what I think is the value maximizing. I don't think this leads me to second guess that, but it says today. I'd like a little more cautionary language about the today part. That's good for all of you, but it doesn't mean, do I rethink the previous papers? Last one I would say is, portfolio managers are important, but some investors go act directly. They don't work through portfolio managers. And so just to give us some context of in what settings are portfolio managers' constraints likely to limit the impact of institutional investors, and in what settings will they not? Lots of controlled owners out there that aren't even affected by portfolio managers. There's that. I just like to see that context. Just in the end here, look, the message should be, these are great papers. They're focused on important problems. They provide new insights here. Could they be better? We can all be better. Thank you so much for giving me the opportunity to discuss.
Thank you very much, Alexander. Now the Conor Kehoe.
Thank you very much. Alexander's stolen all my best lines. It's terrible. Why did I go second? I loved these papers. They're full of new data, historical data interpreted in one case, and brand new data, self-assessment, in the other. So let me just take them one by one. Let me start with Andre. And while I was reading it, and while I was listening to him, it reminded me of I was at dinner with a professor, Lars Hansen, and Lars is an asset pricing expert, and he won the Nobel Prize for his work in this area. And during the dinner, I said to him, look, how good is mathematics at modeling human behavior? Because, I thought that's a good question. I better ask him something. And his answer was really interesting. He came back to me and he said, I want economics to be a science. If it's to be a science, it needs the rigor of mathematics. And he stopped there. So it was a desire and a belief that drove him. He'd love you. The way you've treated the data, I think it would be right up his street. My encouragement to you, and I mean, my stance in both papers is I'd love more. But the more I'd love from you is what's going on in the minds of investors that produces the result that you just described. And I think what you described was they underreact initially, and then over time they integrate data slowly. And yeah, I was a bit confused too. I was thinking maybe they were onto a good thing not integrating that data because it was so poor. But nonetheless, they integrated, and they integrated slowly. And so I started to and you talked about behavioral inattention, behavioral biases. And I had the great pleasure of working with another eminent economist, in a sense, though he was a psychologist, Kahneman. And so I started to think about, and I wonder if you'd be interested in understanding which behavioral biases were being manifested. And this is my only opportunity to have funny slides. Hang on a second, I'll go backwards. So it could be that, we're just too busy. This is inattention, which is a status quo bias, which has been well documented. So you might want to go there, or there might be others. It might well be anchoring. Judges are given hypothetical cases, and they throw a pair of dice in front of them, and when they sentence, they're heavily affected by the number they've seen in front of them. It's hard to move off. So in a sense, it's kind of status quo, but once you've seen a number, it's hard to move off it. Or you might want to explore what you see is all there is. And these are the people, there's an elephant in the middle, and they're describing it. So I don't know what the right answer is, although as you spoke today, there was also an element of confirmation bias. I look for data that supports my current position. I don't look that hard for other data. So my encouragement to you would be to try and see what is causing people to ignore data, to underreact initially, and then to integrate it slowly afterwards. Now, you talked about behavioral biases, which got me down the track, and there's also funny cartoons, so I thought I'd share that with you. But I think there is another way of going about it, which is to say they're behaving perfectly rationally. These are men and women making decisions, within organizations. And there was an economist who said markets can remain irrational longer than you can remain solvent. Well, I've put a variation on this. So that's John Maynard Keynes. And markets can remain longer than the time remaining to your next evaluation. And so if you are somebody pricing assets, and you're in an organization, and most of these men and women are in big organizations, and you're highly rational, you're thinking, when's this market going to move? And so when should I be in? If I go in too early, and it's not going to move for a few years, it's going to take a long time for them to ingest the information, how am I going to look in 6 months' time? So my proposal to you is to take that next step, maybe on a micro level, and ask yourself, if you like this kind of thing, Professor Hansen mightn't agree, what's driving the individual decisions that ultimately make up those observations you made about the markets? So that would be my proposal to you. But thank you so much for this wonderful data, which I think will be extremely useful. I mean, I came away a little bit more pessimistic than you did, because I felt that there was a danger of a death spiral. Do you know what I mean? When flooding happened, there was more attention paid to it. The pricing of the instruments meant that it was going to be harder to raise funds. I was slightly reassured by the discount rate you just described, but I do worry about a bit of a death spiral for these countries. But thank you so much for the paper, and get yourself introduced to Professor Hansen. I think you. And Tom, I've got no funny cartoons for you, I'm afraid. It's terrible, But when I read the paper, I thought, great, integration, ESG integration has happened, because that's what PRI was set up to do. But I did end up then, so I concluded from the paper, by the way, just so what I picked out of it was, first of all, basically, if you think about how people are wasting things, if you are an ESG-oriented or sustainability-oriented investor, essentially you're upping the weighting of ESG at the expense of strategy and current operations. Culture and governance, very important to both, and then the two others swap a little bit. But all are concerned about ESG, as you pointed out. Top topics: employees, consumer health, privacy. What was the next one? It was greenhouse gases and pollution. And the others further down the list. Nature hasn't made it really. DEI didn't make it, and they were similar in that. And then the next thing was, within constraints, they're maximizing risk return, and when they engage, they're maximizing risk return. The one thing that I found interesting, well, many things interesting, but struck me was that the links between ES and performance. Two observations there. One is that they're indirect. And I don't know what that mechanism is. It would be very interesting to see that mechanism. I'll give you 2 minutes. I'm a bit of a wine buff. I love the wines of Burgundy, and some of them follow a methodology which involves being very careful of the vines and putting a horn full of manure into the ground, this too, on a full moon. I'm thinking, what the hell can that be doing? It's devised by a chap called Rudolf Steiner, who also had a school system named after him. But I think when you look at what happens is the amount of attention they have to pay to their vineyard to do some of this strange stuff as a second order effect produces fantastic wines. That's the only way I can explain it. So I thought of that as I read about the indirect effects as you describe them. But what struck me also was the asymmetry. Good E&S leads to outperformance. Yes, according to 45% of those who were traditional investors, and yes, for 73% of those who were sustainable investors. So big difference there. Whereas on the other side, poor ES performance leads to underperformance in future. Basically 2/3 of them agree on both sides. So somehow or other, the sustainability guys are more optimistic on the upside effects, but they're equally pessimistic, as it were, on the downside effects, or they agree on the downside effects. So where would I go with this? Well, again, I was really intrigued. Same thing, I'm a bit of a one-track mind. I was intrigued by how do these decisions get made? The asymmetry reminded me of some work I'd seen by a French academic, and what she'd done was devised descriptions of companies with different levels of ESG competence, if you like, or achievement, and got private equity guys to price them. So she was able to, through this artificial device, see the value of more or less ESG performance, which of course she'd written into the case, and you know, she got the results. I mean, I'll give you a couple of results to indicate. It was asymmetric as well, going from good to very good on S&E increased returns, expected returns by 5%, but going from average to bad, which was supposedly the same thing, decreased returns by 10%. So you might want to think about that. The other way I would do it, and I've done this in the past, is to try and treat these characteristics as almost consumer, how should I say, items of consumer preference, and use things like conjoint analysis. So if you were an investor, how much would you pay for different amounts of E and S? So what am I trying to get at? I'm trying to get at the fact that you've documented so well how they go, what they take into account, but what's the mechanism that translates that into a decision? That's really what I thought might be the next step for what is a wonderful paper. Thank you both very much. And I think at this point in time, we should award the prizes. Isn't that right?
I believe so. And then we'll still have the Q&A,
We'll have time
so
Q&A.
you can still ask questions, but
Okay.
let's do it.
Let's do it. Okay, so what do I do? Tell me. I just congratulate you. Is that right? That's it. Well,
I guess
listen,
so.
Tom,
You get the
well
shake.
done.
Thank you very much.
And
Conor.
Andre, bravo. Thank you
nice
very
to
much.
meet you.
Thanks for that.
And thank you, by the way, too.
Thank you very much, Conor. So now, at this point, we'll open up the floor for Q&A. And since we just heard very thoughtful discussions from both, when we get the first question, I invite the authors to feel free to say anything in response to the discussants' comments as well. So please wait for the microphone. And when you speak, please say your name and the organization you are from. So gentleman on the second row first.
Thank you very much. It was really, really a great presentation from both studies. David from Manulife Investment Management. Just quick question and going even further. So we spoke about portfolio managers, and then we spoke about behavior, about forecasting. Do we think that it would be a great idea to look at what macroeconomists integrate into forecasts? Some of the investment managers rely on some of their internal macroeconomists or even external macroeconomists for their capital market assumptions. And they may want to, discount their GDP forecast or other macroeconomic indicators based on what we think will happen from a social or environmental perspective. So, yeah.
Yeah. Gosh, yeah. I mean, that's the big question. I'm not quite sure how to respond to that. Yeah. Sorry. Yeah. Sorry. I don't really have a great response to that. I mean, I'm not quite sure where to go with that. Do you want to have a go at that?
So for the macro, So the macro side, I've heard of the information that's being produced by them, and I'm not necessarily for my results. Let's say to hold, it's not necessarily has to be investor specific attention, right? It's the market in aggregate. When we think about this, I would expect these forecasts potentially to be integrated by economists as well, and whatever results or whatever portfolio research that they're producing for their investors to potentially incorporate this information. They would incorporate information on GDP growth, population forecasts, etc. So I would potentially expect that this would follow through into it as well. As attention increases towards these types of risks, and especially for coastal flooding disasters that are one of the deadliest effects of climate change, in comparison to things that are slower drivers, such as temperature volatility or temperature and whatnot, these potentially are included already, right? And then, the actual credit spreads, if you think about the reason I use credit CDSs is because it doesn't have necessarily have anything to do with raters, as in the who's trading these. These are counterparties that are developing these products, and they of course incorporate the credit ratings by agencies, but only recently have they started incorporating types of coastal flooding, wildfire, etc. So all of this research that's potentially produced for these investors might be influenced by attention, right?
Could I just say, actually, if anybody comes, I hear now from major investing organizations that they're looking for tools to help portfolio managers make better decisions. So they say, if anybody's got an Excel spreadsheet of an economy going through the climate transition, please send it to me, because that's the starting point for our portfolio managers who are dreaming up new ideas and then want to model them out. So this is a plea. If you see any of it around, let me know.
Hi, Kieran Aziz, Head of Responsible Investments at KLP Norway. It's Norway's largest pension company. First of all, thank you very much for engaging presentations, insightful, but I have to say I'm a little confused because, coming from institutional investor, how should we drive this agenda on sustainable investment, responsible investments? Because there are some conflicting interests, both short-term and long-term, and various point of views, and then you will have circumstances will be changed, and then discussions change as well. So if you could help us to some advice, that would be helpful. And this is for all of you, so please feel to address that.
Yeah, I think if I could start off with that one, I think that we have to approach this question of responsible investing with kind of realism about what the scope of influence of investors is, what's realistically going to be achieved, and then calibrate actions accordingly. And I think if you start at the top of the chain with the asset owner, they're the ones that are going to have the ability really to integrate non-financial and financial considerations over the very long term. So I think one of the things that our research shows that once you get delegated into the portfolio manager, okay, you've got an agent who is operating according to a mandate with very specific objectives as they see it to maximize returns subject to constraints. So I think we just need to be realistic that the asset management industry is not going to lead the charge on using the investment process to improve environmental or social performance, because it's just not the incentives that are set up within that system to do. So then that I think then provides some insight to asset owners, and I think there's a couple of dimensions here. So one is that asset owners need to look both at the detail of what's in the mandate, because that's going to be really critical in terms of a portfolio manager prioritizing anything other than returns, but also the beliefs of the portfolio manager do matter, right? So it's not just the mandate, it's also the means by which the portfolio manager is going to try to maximize returns. So if you choose a portfolio manager who has a belief in the value creating possibilities of ES, they're probably more likely to do the work to understand and integrate those factors into the investment process. But notwithstanding all of that, we still have this sort of overarching limitation that I think it's very difficult to expect the investment industry to solve for economic externalities. And I think that one of the things that the industry has sometimes sort of tripped itself up on is kind of getting dragged into the idea that it will do that, right? When actually it never will. The industry will go so far, but no further. And there comes a point where I think the industry has to kind of push back a little bit and say, yeah, absolutely, we'll take all of these factors into account in terms of long-term sustainable value creation. But let's just be really clear. If there's a massive unpriced externality, that's not going to be enough. That is not going to solve the problem. And there is no way that we're going to be able to correct for that through our actions. And that's where I think some of the point around engaging with policymakers becomes extremely relevant and important.
I'll be very quick. I mean, I look back at when the PRI was founded, what was on the list of things the PRI should do? And obviously top of the list was ESG integration into investment thinking. And you've seen a lot of evidence that that's gone a long way. And the other was data, and mandatory reporting is present in the EU, California. What's interesting with the things they didn't do, on the agenda was we should work as responsible investors to align incentives all along the investment and corporate board chain more closely with the time horizons of beneficiaries. It says that we're undone business. I've worked with very, very large asset owners, indeed in this country, and when you really peeled it down, the board was heavily affected by the reaction of the press to the annual disclosure of returns the previous year. Yes, they had 25-year money, but the psychology of the board, and they admitted to it, and they've done something to deal with it, was too one-year oriented because of press criticism. So I think all along the chain, and there are ways of dealing with this, trying to extend time horizons and incentives behind time horizons, and press reaction is an incentive, to align it more with the beneficiaries, your ultimate beneficiaries, is important. And a second mechanism, which was looked at 20 years ago and they decided not to do, is systematic consultation with beneficiaries, which might be a further way of reinforcing in the asset owner and then the asset manager and maybe the corporate board's mind to align themselves on a longer term basis rather than short-term performance. So I haven't got a complete solution for you, but I offer you those observations.
Appreciate your question, and if I may just say a few words just to use my privilege of moderator a little bit. I think Tom's results are quite consistent with some work I have done where I try to look at the sustainability goals of those managers. I'm looking at fund managers, and I also find that to use the value versus values contrast, the majority of the fund managers are they say they are maximizing value, not the alignment with values or impact. And I think one of the challenges that these managers face is that they're all competing with each other. And of course, even the asset owners who want, let's say, impact, still care about financial returns. So then when they're compared next to each other, there is a challenge that impact investors face. So I think one of the challenges that they are not really labeled clearly separately. So then what we don't know is the fund managers like to offer these value products, but what we don't know is there a good matching between asset owners' objectives and the portfolio managers' objectives that they're pursuing, or is there a potential mismatch and there's some confusion as to which goals that your fund managers are maximizing. So that's some remaining work to make those labels more clear and separate. Sorry, I used 1 minute. So next questions. Yes.
Hi, Younes from IA Global Asset Management. So I have a quick question on, you touched on the discount rate in the second paper, and it made me think, and I'm quite intrigued on, when we look at the cost of climate change, we're forecasting in 30, 40, 50 years. So if we use a discount rate, which is economical, like if we use, for example, 5-6%, and we discount those costs to today, it will cost nothing. So we should, hearing you talk, we should use a lower discount rate. But are we using the right now, like when we think about the finance theory, like the easier model, the DCF, and we discount, so we're going to model the next couple of years, and then we're going to use a terminal growth rate, which will be 5, 6, 3%. But if we use the same rate to discount those costs, we're not going to see those implied costs of climate change in actual valuation. So are we using a correct approach, or should we change our approach to discount rate?
So my question, sorry, that's an interesting question. I'm thinking about it specifically more from an infrastructure development way. So how can we think about? I think your question is thinking about how is it for climate change in general. This is much more specific. Most of the climate literature has found a discount rate anywhere between 1% and 4% for the negative consequences. So all I'm trying to say is that my findings are somewhat similar in this case, and therefore the infrastructure you can build to finance this actually is it's useful that it's fairly low in this case, because then it could be potentially cheaper or give you the government more incentives to build out protection for high population areas to protect against potential GDP losses in the future. So that's really the extent of the policy takeaways. But I'd love to talk to you a bit more about it in person. Yeah.
Hello, my name is Erik Torhan. I'm head of corporate governance for I'm over here for a Swedish-based asset manager called Lannebo. I've always said that the academic track is why we come to PRI, and this was excellent. So thank you so much. But I have a question for the first paper. Professor from Toronto alluded a little bit to the geographical spread of that it wasn't really different in opinion between different geographical spreads, and that really surprised me. Could you maybe talk a little bit more about that?
Yeah, sure.
Something from a Nordic context, because
and I mean, I think we'll dig more into the geographic split. But what we found is that there aren't no differences by geography, but the biggest differences are definitely the sustainable versus traditional split. So that's what explains the most interesting and marked differences. There is undoubtedly a cohort of US traditional managers that are slightly more, in every question where there's a difference between traditional and sustainable, the US sub-cohort of the traditional managers is slightly more along the spectrum than the non-US traditional managers. So there's not no difference. There is some difference there. It just wasn't a first order difference in the same way as some of the difference between traditional and sustainable managers were. So, and actually the spectrum, when there were differences, it was in exactly the sort of direction you would stereotypically expect. But interestingly, that difference really was not there in the sustainable fund managers. So it was just in this kind of cohort of the traditional managers. But I mean, it's good. It's a good feedback. I mean, I think I do agree that we need to address that a little bit more explicitly, given some of the other findings that have been around geographic differences.
We have 2 questions. Oh, 3. So quick, and then we'll just collect all 3 questions and then answer. So gentleman with the microphone already, and my gentleman here, and then the lady in the middle row. So in succession, please be brief.
Great. 2 great papers, Atreya and Tom, so thank you very much. Andrew Kay from Walter Scott and Partners. I mean, I think one conclusion, possibly, Tom, is that if you want to put your money to work as a responsible investor, you may be better off giving it to a mainstream manager that has the size of ownership stake to make stewardship an active kind of force for good. Any kind of thoughts on that? Or, are labeled sustainable investment funds possibly a distraction, given your findings?
Hi, my name is Ken, based in Singapore. A quick question for Tom. Thank you for the paper. Did you consider maybe splitting it into 3 cohorts instead? So traditional, sustainable, and impact. And I just want to draw the parallel to Prof. Ayako's research, who I met at Grassfee, because I think you do split into the 3 cohorts, and the impact cohort might better reflect. Having more distinctions might better reflect those preferences. Thanks.
The final question. And sorry, we are running out of time, so maybe we'll just collect the questions and just, but thank the discussion. Yeah, go ahead.
So very quickly, Eugenia Jackson from PGIM. Kind of similar question, but I got a different conclusion. I got a conclusion that the asset managers or portfolio managers are doing exactly what they asked to do, optimize for risk-adjusted returns within given constraints. So my question is, if we want to optimize for ENS performance, should there be a specific mandate to optimize for that, and that would deliver better results on ENS side?
Yeah. Okay, so very, very briefly, Ken, your question, and we didn't ask separately for impact managers. I mean, this is about listed equity portfolios, and I mean, you can have a debate about whether there is such a thing as a listed equity impact manager, but I mean, I think we didn't feel it was a big enough subcategory for us to look at. I guess I can answer the other two questions a little bit together. I mean, you know, the reality is that if you want to get your portfolio manager to sacrifice financial value as a trade-off against environmental and social factors, you've got to build that into the mandate, right? I mean, they're not just going to do that. The reality is, though, it's quite difficult to build that into a mandate. And the reality is that most of the mandates are quite blunt instruments that relate to either exclusions or demands that you engage on certain stuff. So that's only going to get you so far. So you might decide that actually a traditional manager that really cares about ES and really integrates it thoughtfully might get you more, but that is never going to get you a trade-off between ES and value. So there is a fundamental dilemma here for asset owners seeking to get their preferences met if they genuinely have ES and financial goals through a delegated fund management model. I mean, and it's a challenge.
Sorry, time is up, but you're welcome to stay and continue your conversation with the presenters. And before we thank the presenter, I just want to make one more announcement. I hope you enjoyed this academic session, and if you did, please scan these QR codes on the screen to learn more about the academic program, our next upcoming events, and how you can be on the list to learn about that, what we do at PRI. And also, please fill out a short survey you will get in the email to tell PRI how you enjoy the academic session. So let's thank the discussants and authors and the audience for generating great discussion on the great two papers.